The recent banking stresses in the United States and Switzerland are a reminder that risk can materialize and spread quickly. They highlight that the business models of some financial institutions rely too much on an environment of low interest rates and low market volatility. Fortunately, authorities in those countries took swift actions to limit the spillover effects of these stresses to the broader financial system. Equally important, banks around the world are more resilient today than they were before the global financial crisis, thanks to significant improvements in financial buffers and risk management practices. Here in Canada, regulators have taken important steps to ensure that Canada's financial system and Canadian banks remain robust. Nevertheless, if global financial stress were to reemerge and prove more persistent, Canada could see significant spillover effects, especially if stresses triggered a severe global recession and interacted with existing vulnerabilities. Let me now turn to Carolyn to discuss all of this in more detail.
Thank you, Governor. As the Governor noted, the FSR is not a forecast. It's a deliberate look at what could go wrong and the resulting implications for financial stability. And this year we've reorganized the FSR to make our communication about these potential risks clear. We've moved away from discussing financial system vulnerabilities and risks separately. Instead, we've combined them and organized them under key sectors or areas of focus. This approach reduces repetition and allows for a more concise analysis of the kind of risk that could arise if future shocks were to occur. You can expect further changes and refinements in next year's FSR. Let me take you through 3 areas we're monitoring closely. The first is Canadian bank funding. Banks channel money from savers and investors to borrowers. As interest rates go up, banks need to pay savers and investors more, so the funding they use to make loans becomes more expensive. This is an intended outcome of monetary policy tightening. The increase in bank funding costs is coming at a time when sources of low-cost deposits are declining, and Canadian banks generally have more demand for loans than can be funded solely by Canadian deposits and investments, so they rely on attracting additional funding from global wholesale markets. These markets can be significantly affected by global events such as recent banking stress. We're closely monitoring the combined impact of these factors on bank funding. The recent turbulence in global markets stemming from bank failures had little direct impact on Canadian banks. But if global stresses were to return and persist, bank funding costs could rise beyond the higher levels intended by tighter monetary policy. In addition, in a severe stress situation, funding could also become harder to secure. In response, banks could likely constrain credit to households and businesses, potentially exacerbating an economic downturn. The second area we're monitoring closely is the interaction between global stresses and liquidity in fixed income markets, both globally and in Canada. In an environment of greater pressure on bank funding, major banks may have less capacity to supply liquidity to market participants in periods of stress, which is when they need it most. This market liquidity is crucial to financial stability, given the growing importance of asset managers and other non-bank financial intermediaries that rely on it. The extreme market stresses at the outset of the pandemic showed that the financial system is vulnerable to sudden spikes in demand for market liquidity. The third area the bank is watching closely is the ability of Canadian households to service their debt under higher interest rates. Higher debt servicing costs are stretching budgets and reducing borrowers' financial flexibility. About 1/3 of households have seen their mortgage payments increase since February 2022, just before the bank started raising the policy interest rate. More households will see their payments go up in the next few years as they renew their mortgages. Lenders and regulators are taking steps to provide borrowers with options for managing higher payments, such as extending amortizations. However, as borrowers make use of these options, they may have less capacity to absorb future shocks. Canadians have a long history of paying their debts, even under stressed conditions, and so far households are proving resilient despite the sharp increase in interest rates. However, in a severe and prolonged recession, mortgage defaults could rise, leading to credit losses for lenders. That, in turn, could lead to a further pullback in credit, worsening a downturn. This review also outlines emerging risks that we're monitoring, including cyber incidents and climate-related financial risks. It also provides an update on developments in crypto asset markets. I'll conclude by underlining a few important things about resilience. The vulnerabilities that we describe in the FSR may not, on their own, threaten financial stability, but shocks tend to have more impact when vulnerabilities have built up. So our main message is that as the adjustment to higher interest rates continues, financial institutions need to adapt, and central banks and regulators need to be extra vigilant. I also want to assure Canadians that the steps taken to bolster our financial system are proving their worth. Canadian banks are held to the highest global regulatory standards, and they're subject to rigorous supervision. At the Bank of Canada, we will continue to monitor the financial system closely for signs of stress, and we have the tools needed to provide emergency liquidity if severe stresses develop. In fact, we've recently reviewed our pandemic-related liquidity interventions to help us better target our response in the future. We stand ready to act, if needed, to safeguard the stability of the Canadian financial system. The Governor and I would be pleased to take your questions now.
Okay, thank you very much, both. We will go to questions now. We do have reporters here in Ottawa at the bank. We have some at a regional office in Toronto, and we have some on the phone lines as well. So I'm going to start here in the room, then I'll go to Toronto, then the phones. I will ask everyone to limit yourself to one question, please, just to make sure that every outlet has the opportunity to participate today. If I forget to do so, please state your name and affiliation. I'll just remind the people on the phone, please only unmute your line to ask a question and then go back on mute as soon as you have finished, just to avoid unnecessary noise on the line. It's the *6 button on your phone that toggles you between mute and unmute. Pour mettre votre ligne en mode discrétion, appuyez sur étoile 6 et pour l'enlever, faites étoile 6 encore une fois. Et avant de poser une question, veuillez vous identifier et, comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. So, with that, let's go to our first question. Here in Ottawa, I'm going to call on Randy from Bloomberg, please.
Good morning. With the housing market heating up again, headline inflation reaccelerating and growing concerns around household, how do all of these inform the bank's thinking around whether the current rates are restrictive enough?
Well, look, we're really here to talk about financial stability today. This is our financial system report. I'd stress a couple of things. First of all, the bank has two mandates: price stability, financial stability. We have tools for each, and we can pursue both at the same time. It's not one or the other. As I mentioned in my opening remarks, financial stability is a precondition for price stability. At the same time, price stability is really the bedrock of a stable and efficient financial system. With respect to monetary policy, I'll just repeat what we've been saying for some time. We're determined to get inflation all the way back to the 2% target. Inflation's coming down. We expect it will continue to come down. Our next monetary policy decision is on June 7th. We'll be looking at all the data we've received over the last 6 or 7 weeks, and we'll announce our decision. Today, we're really here to talk about financial stability issues. With respect to housing, look, housing is part of the economy. It's certainly something we look at with respect to monetary policy, but it's one part. It's an important part, but it's one part, and you got to look at. We've been pretty clear about the things we're looking at we're most focused on as we use monetary policy to get inflation back to target.
Okay, our next question will come from Steve Shearer of Reuters. Please go ahead.
Hi, Governor. I know that the focus is financial stability today, but the last time you spoke, you said that you were prepared to raise rates again if inflation doesn't start going toward 2%. And in the meantime, we've had an inflation report that actually rose for the first time in 10 months in the headline inflation number. Can you speak to the changes that you've seen? There was also a labor report. Is there, has the landscape changed since you spoke last to us?
Well, I do want to focus on financial stability issues, but I will speak to your question. Look, as I just said to Randy, inflation has come down. It is coming down. We expect it will continue to come down. The April CPI report did come in stronger than we expected. Energy prices in April moved back up. Food price inflation eased off a little bit, but it's still much too high. If you look at some of the more underlying elements, service price inflation on an annual basis eased back a bit. Our two preferred measures of core came down a little bit further. Look, as we've said repeatedly, we are committed to getting inflation all the way back to target. There are a number of things that have to happen to get inflation back to the 2% target. We've got to see the labor market rebalance and wage growth ease off. We need to see corporate pricing behavior normalize. We need to see near-term inflation expectations come down. So those are the things that we're going to be watching closely. And as we've said, we're using the pause to assess whether we've increased interest rates enough to get inflation back to target. So, looking towards our next decision, June 7th, yes, we've got a new CPI. We're going to get new national accounts. We're going to look at, both of those together with all the data we've received, and, we'll come to a decision on June 7th, our next monetary policy decision. And look, we'll have more to say on monetary policy at that time. Today, we're really focused on financial stability issues, and as we both stressed, this is not about forecasting. It's really about trying to assess what could go wrong and making sure that households, businesses, regulators, central banks, financial institutions are well positioned to manage those risks.
Okay, I'll turn now to Raul from Epoch Times, please. Go ahead.
Good morning. Regarding the higher interest rate environment and adjusting to it and the vulnerabilities that are created, can you speak to the risks to the financial system and stability of rates being higher for longer than needed, given that, or when it would be appropriate to start bringing rates lower, which would presumably ease some of these vulnerabilities? So like if rates are 150 basis points in restrictive territory and inflation's projected to return to 2% by the end of 2024, would you expect rates to have to trend towards the neutral zone, neutral area, in order to ease some of these financial vulnerabilities, or how do you see that playing out?
Well, I'm going to give a very short answer on monetary policy and then turn it to the Senior Deputy Governor to bring it back to financial stability issues. But look, on monetary policy, I'll repeat what I just said. We're using this pause to assess whether we've increased interest rates enough to bring inflation back to target. There is no hint of cuts in that statement. It is far too early to be thinking about interest rate cuts. Inflation is coming down, but we have some distance to travel to get inflation back to the 2% target. The message in this report is that we're going through a transition to higher interest rates in the sense higher interest rates than what people got used to. And along that transition, there are some risks, and it's important that we are vigilant through this transition. And perhaps you could expand a bit on the key ones that we've highlighted.
Yeah, I mean, when it comes to financial institutions, like households, they're adjusting after a long period of low interest rates. The banking stress that we saw recently in the U.S. was an example of a small number of institutions that were not well positioned to deal with a sharp increase in interest rates. And we saw some of the vulnerabilities play out, and they created some pretty extreme, well, very extreme stress for a small number of institutions that had a ripple through the banking sector. So, in the FSR, we outline the risk that that if that were to reoccur and spill over, that it might have on the Canadian banking sector. We don't see those same sort of combination of features in those U.S. banks in our banking sector, but the point that we make in the report is, as the governor said, through this period of transition, it's a time to be extra vigilant.
Okay, I'm going to call on Jordan now from CTV. Please go ahead.
Hi, the FSR highlights that business insolvencies are back up to pre-pandemic levels. How concerned are you about the small business sector, particularly because it's the #1 employer in Canada, and particularly because they have to start repaying their pandemic-related loans and such in a high interest rate environment? Thanks.
I'd start with one important point to keep in mind when you're looking at some of the data that comes out. So insolvencies and other indicators of financial stress, it's important to keep in mind what the starting point is. So we saw a lot of these indicators really plummet in the early part of the pandemic, go way below historical averages. So it is true that they're coming back up. What they are doing, though, is returning to sort of more normal levels. So again, what we talk about a lot in this FSR is sort of the normalization of the economy as we sort of adjust to higher interest rates. So I would just make that point about when you're looking at these data points to make sure you're understanding what the starting point is. Having said that, it's not to minimize the stress that small businesses are facing. We do mention in the FSR that the small business sector is an area that we have an eye on. We don't have a lot of data about that sector. We look at some of the same indicators that you do, the Statistics Canada data, the Chamber of Commerce data. When it comes to CEBA loans, we know some businesses have these loans sitting in deposits. For them, it will be relatively easy to pay back. Other businesses have used them as a buffer to get through the pandemic. It will be more difficult for them to pay back. So this is something we'll definitely be watching.
OK, notre prochaine question va de M. Olivier Ferrand-Boissé du réseau.
Next question is Olivier Ferrand-Boissé of TVA. Hello, I'm wondering if you believe that the Canadian banks were predicting enough in the last years when it was time to give loans, were very careful enough. Do you believe that they made sure that the borrower had the capacity to absorb these higher rates as we expecting in the next renewal? One thing that was put in place was the stress test for mortgages. And one message in our report is that this policy was very useful. And what it did is that when you apply for a mortgage, when the interest rates were very low, the mortgage was tested at a 5.25 interest rate, 5.25 interest rate. So in the mortgage, we tested by the household was able to pay back their mortgage even if the interest rates were to reach that level. So that's one aspect. And I believe that it was very useful and is to help households to be more resilient to the higher interest rates. It doesn't mean that each household has no problem to repay. Some households have difficulties, but in general, we believe that the households are resilient and they are paying back their mortgage.
I'm going to call on Greg Quinn from Market News next, please, and then we'll go to Toronto.
Okay. I may be throwing ball 4 here, but we'll see. I noticed something in your annual report that I wanted to get into. It mentioned that staff costs rose 4% last year, including a 10% rise in salary costs, which I believe is a combination of new hiring and pay raises. The bank has stressed often that it's not good for the economy at large to have outsized wage increases is not consistent with 2% inflation. So how does that message that's been given about national wage increases reconcile with what the bank is perhaps doing internally?
The Senior Deputy Governor may be able to give you a few more details, but I think the main thing is we have a new function at the Bank of Canada, which is the oversight of retail payments systems, and that has resulted, in order to build that function out, we have hired more people, and that, of course, is reflected in the overall salary bill. In terms of our across-the-board bank-wide increase for all bank employees, last year it was 2%. I don't know if you have anything to...
Not much to add to that.
Okay.
Pretty straightforward.
Okay, before we go to Toronto, I'm just going to say that on the phones right now, I've got BNN, Global News, and the Globe and Mail. If anybody else has joined the line and wants a question, please send a quick email to communications with an S at bankofcanada.ca, and we'll get you into the queue. We're going to go to our regional office in Toronto right now, and our first questioner there is Stephanie Hughes of the Financial Post. Stephanie, please go ahead.
Good morning. Questions. Rising mortgage costs have played a big role in this financial system review and in reaccelerating the latest inflation reading. As the Bank of Canada mulls over keeping rates high for longer or even hiking further, what's the central bank's thinking around how rising rates could contribute to mortgage inflation, which could contribute to overall inflation and potentially exacerbate some of these household debt risks laid out in the report?
Well, I'll say a word on inflation and turn it to the Senior Deputy Governor to say a word on the risks in the report. I mean, with respect to inflation, housing shows up in a number of ways in the CPI, and increasing interest rates affects those different pieces differently. So one way is the cost of repairing your house. Those sort of costs, Statistics Canada uses the new house price index to gauge that. Housing prices went up very sharply through the pandemic, up more than 50%. They're down about 15% on a national basis from the peak. And that gets reflected in one part of housing costs in the CPI. Of course, another very important part is mortgage costs, and with interest rates having risen rapidly to control inflation, mortgage costs are up. I mean, that's an intended effect of monetary policy. That's how monetary policy works. That's how ultimately monetary policy will get inflation down. But obviously, it has some direct effects. So you have to look at the total effects of the increases in interest rates on housing, and I mean, the reality is, higher interest rates are working. Inflation is coming down. We're assessing whether we've increased them enough to get inflation back to target, but inflation has come down reasonably quickly so far.
And Stephanie, I'll just add, to the second part of your question. I mean, I think the work we've laid out in the financial system report is basically getting at exactly the question you asked. What do we foresee as higher interest rates? If we project the higher interest rates into the future, what do we see in terms of debt service impacts for households? So, the immediate effect we outline in the report, there's been about 30% of households who have mortgages have seen their payments go up already. Those are people with variable rates and variable payments. As more households renew their mortgages into the future, we will see most of them renewing at higher interest rates, which will mean higher payments for many households. It really, similar to the previous answer I gave, the starting point matters a lot. So it'll depend on the difference between the interest rate that the mortgage was originally taken out at and what they're renewing at. This is where the policy the governor previously mentioned, OSFI's guideline about stress testing mortgagors at a 2% interest rate differential will help. It will have created a buffer for many of those households that are renewing at higher interest rates. But, this is monetary policy. It's the lag that we often talk about, how higher interest rates play through different parts of the economy at different paces and affect different parts of households, different household groups differently, so.
Okay, and now we have Sammy Hudez from Canadian Press. Please go ahead.
Hi there. When it comes to the recent global banking stresses that were touched upon in the report, it mentions how social media and digital banking played a role in those bank runs in the U.S. this year. I'm wondering, as we touched on Canadian vulnerabilities, how does, that element of public panic and social media potentially pose risk to the Canadian financial institutions in ways that you didn't have to worry about maybe 10, 15 years ago?
Yeah, I mean, what social media did was really exacerbate that sort of extreme event that we worry about, which is a bank run. So what social media does is let that sort of loss of confidence spread much quicker, and that combined with a lot of digital apps that let people move money more quickly means that a run plays out more quickly than it has in the past. The thing I would point out, though, is it takes more than one thing to see a bank fail. So social media definitely played a role, but there were a number of other things that were unique to the institutions that failed. First of all would be a high concentration of depositors. So these banks had a small number of very large deposit holders, and so that meant that when those depositors left, there was a very drastic change in their deposit base in a very short amount of time. These banks also had a mismatch between their assets and their liabilities, so they were taking short-term deposits and making long-term investments. Banks do that all the time, but it's a risk that needs to be managed very closely, which would bring me to the third point, is these banks had big lapses in their risk management practices. So yes, social media definitely played a role, but it takes more than one thing to keep banks strong. It takes more than one thing for a bank to fail. So it was a part of the story, but I think it was a small part.
Yeah, I'll just add that I think overall the combination of swift and forceful response by U.S. and Swiss authorities and a banking system that is much more resilient today than it was in 08, 09 because of the reforms that were put in place, that has meant much less contagion. But we do need to learn from each new development, and one of the things I do is I chair the committee that oversees the Basel Committee, and the Basel Committee is reflecting on a number of the lessons, and one of them is, in a world of social media, in a world where banking is more digital, could deposits run off more quickly, and what does that mean for the calibration of the liquidity buffers that banks need to hold? So I think as a system, we are reflecting on what the lessons are. I think it's going to be important that work. I'm very supportive of that work. I'm looking forward to seeing the conclusions, and it's going to be important to work through that on a global basis because banking is a global business.
Okay, we're going to go to the phone lines now, and our first questioner, I have David George Kosh from Bloomberg BNN. Please go ahead.
Hi, Governor. I have a question regarding the increase in mortgage payments seen over the next few years of 20 to 40%, depending on what kind of mortgage you have. Are you able to maybe provide some more analysis or insight about the impact that you think that this reduced financial flexibility would have on Canadian households amid the rise in debt service ratios, as well as the expected jump in mortgage costs over the next few years?
Yeah, well, I would come back to a point we make all the time is we can talk in averages, but those averages sometimes hide extremes. So it really, again, it depends on the starting point. So as mortgages renew, it will depend on the rate that the mortgages were at when they were originated, when they were taken out, how big that jump in payment will be. The other thing to keep in mind is there will be mitigating factors. So normally, if you're renewing a mortgage that you took out 5 years ago and you see a jump in payment, it's very likely you will have had some increase in income that will offset that payment. You will also have had 5 years to pay down to build some equity to pay down your mortgage, so you have a little bit of flexibility there. So you have room, if the payment increase that you see creates stress in your household budget, you do have a number of ways to mitigate that stress. So it's very hard to generalize. What we tried to do in the FSR is sort of forecast out over a period of time what we expect to happen to household mortgage payments. But really it comes down, how each household deals with that increase in mortgage comes down to very specific circumstances related to them.
Okay, our next question is Craig Lord from Global News. Go ahead, please, Craig.
Hi there. Just following up on some of the mortgage paying discussion. Previously, we've heard a lot about the importance of front-loading interest rate hikes to make the paying kind of last a little less longer and be more efficient with bringing inflation back down. As you're gauging and reevaluating the impact of rate hikes to date on the financial system and specifically on consumers with mortgage debt, does it suggest if we do need another rate hike in this cycle that it would come sooner rather than later?
You're very determined on monetary policy, aren't you? Look, I do want to stay focused on financial stability issues, but I will speak somewhat to your question. Look, I think the key message in this report is, yes, we've raised rates rapidly. That was needed to control inflation. And going forward, nobody should expect that interest rates are going to go back down to the very low levels that we've seen over the last decade or so. So we're in a transition period to a world where interest rates are going to be higher than what many people have gotten used to. And that transition, one of the important messages in the report, and as Carolyn just outlined, we've mapped out that transition for mortgages. That transition is going to take a while. And through that transition, that creates some risks. And we highlight in the report that we are more concerned about the ability of households through this transition to manage their debts. That is something we're watching very closely. In this report, we're really focused on it from a financial stability point of view, financial system point of view. We also take into account when we're setting monetary policy decisions that if households have more debt and interest rates are higher, the effect of monetary policy is bigger than it otherwise would be. There are mitigating things too. Households have more savings. So you have to sort of look at all that together. With respect to how well the system is coping, a second key message in the report is that so far the system actually is coping reasonably well. Households are proving resilient to higher interest rates. That doesn't mean that nobody's feeling any pain, nobody's feeling squeezed. No, some households are really feeling squeezed. If you had a variable rate mortgage, the increase in interest rates hit you very quickly. It is a difficult adjustment. And as we've outlined in this report, if you've got a fixed term 5-year mortgage, those are going to roll through over time, and subsequent cohorts of households are going to feel the effect of the higher interest rates. That's going to squeeze their budgets. That's going to slow down spending. That's what gets inflation back to target. But what we're seeing is that the system is coping with this reasonably well. Households are proving resilient. Canadians have a long tradition of paying back their debts. We mentioned the mortgage, some of the policy measures put in place I think have been helpful. The mortgage stress test has made that more manageable. And our financial system remains strong. It's well capitalized. It's got good levels of liquidity and sound risk management. So far, things are going reasonably well. This report, though, is really about highlighting that through that transition, there are some risks, and it's important to be vigilant.
Okay, I'm going to go now to David Parkinson of the Globe and Mail. Please, go ahead.
Oh, hi, Governor. I wanted to ask you about interest rates. No, I'm just kidding. We
Thank you.
Talked a bit about the. Yeah, you're welcome. Talked a bit about the some of the coping mechanisms that banks and their mortgage clients can adopt to try to mitigate some of this stuff, and the notion of longer amortizations came up as one of those, and I'm wondering what your position is on extending amortizations through throughout the entire mortgage universe, including extending the maximum allowable amortizations. Is that something that you feel would be a positive move, or are there risks to think about around that?
Let me take that one, David. So I would say two things. Amortizations are a buffer that households can use if they find their payments go up and squeeze their budgets more than they can deal with. So amortization is a good sort of release valve to help deal with temporary increase in payments. The Financial Consumer Agency of Canada recently put out a really helpful guideline to make sure that Canadians understand that they can talk to their lenders about extending the amortization as one way to cope with higher payments if they're finding that it's putting too much stress on their budgets. The point that I think you're asking about is, what about just structurally changing amortizations and increasing them across the board? We don't think that's a good idea for exactly the reason that removes the buffer that households have when they face stress. So if we change the structure of amortizations and we push them out, that means mortgages at origination, when they're taken out, have a maximum amortization. That means there's no buffer when they meet a stressful event. So we would rather see amortization extensions used on a sort of borrower by borrower situation as a sort of stress release valve rather than a sort of structural change to the mortgage market.